8 years ago, I was trapped in a Manhattan office despite having millions in the bank. Today, I'm unemployed by choice because the income from my portfolio, which is 40% private equity, covers all of our essential expenses. But before you rush into private equity like I did, there are 4 critical mistakes that could cost you everything. I lost $300,000 learning this the hard way so that you don't have to. In this video, I'll show you the 4 benefits that convinced me to go 40% private equity and the 4 risks that nearly wiped me out and how to tell good deals from disasters. Here's what most people get wrong about building wealth. They think they need $10 million in index funds to live off of their investment. That's the lie that's keeping high earners broke. Save 25 times your expenses and withdraw 4% forever. You've heard it before, but that math traps you in accumulation mode for decades while your wealth sits there doing nothing. Let me show you what I mean by telling you about my own journey. I made my first million through 3 IPOs, Splunk, Yext, and GitLab. At the Splunk IPO, I watched my expected 1.5 million turn into 3.3 million in 5 minutes as the stock price jumped from 17 to 34 on the NASDAQ screen. But here's the thing. Even with millions in the bank, I was still trapped in that Manhattan office, disappointing my family every Friday night because my wealth wasn't working for me. The breakthrough came when we moved to Austin. We sold our California home and bought our primary residence plus 5 single-family rental homes. Those 5 homes generated enough income to cover a good portion of our housing expenses. That's when it clicked. This is how this whole thing works. Assets generate actual income, not just hoping for appreciation. But managing real estate myself wasn't all it's cracked up to be. That's when I went deep into the world of private equity and found people that do this and only this at scale. Get the income without the management. Private equity offers 4 things that public markets simply can't match. First, real cash flow. Instead of hoping for a 2% dividends, my very first private real estate equity deal paid me $2,300 a quarter while growing my original principal. That's real income you can live on. Second, asymmetric returns. One multifamily fund I invested in returned 2.3x my capital in 3.5 years. Your stock portfolio can't do that consistently. Skilled operators in niche markets can deliver these kinds of multiples when they know their space. Third, tax efficiency. Real estate private equity offers depreciation and cost segregation that can offset your passive income. Last year, I had $180,000 in distributions, but I only paid taxes on $40,000 due to depreciation benefits. The fourth is true diversification. Most high earners, and especially tech professionals, are overexposed to a single stock or sector, especially those working for equity compensation. I was guilty of this too and had 70% of my wealth in tech stocks. Private equity gets you into tangible, cash flowing assets that don't move with the stock market. Remember, money is made through concentration. It's preserved and grown through diversification. But here's what nobody tells you about the risks, and this is where I personally lost that $300,000. This is my most expensive education. I invested $300,000 in what looked like a rock-solid ATM fund. Great returns, experienced operator, 10-year track record. The sponsor had been delivering 22% cash-on-cash returns like clockwork and trusted investors, including somebody who I'd respected, who'd been in PE for 20 years, were thriving with it. I started smart with $100,000, their minimum. 18 months in, those monthly distributions were so consistent, so reliable that I got comfortable, too comfortable. I broke my own cardinal rule about position sizing and threw in another $200,000. Why spread risk across multiple deals when this one was printing money? Fast forward to 2024. The operator started mismanaging the business and the entire $135 million fund collapsed into court proceedings. The monthly payments stopped. My entire $300,000 is gone forever. That's when I learned that in private equity, comfort is the enemy of discipline. The moment you break your own risk management rules because something feels safe, that's exactly when you're most vulnerable. Here are 4 risks you want to fully consider before pulling the trigger on your first or next private equity deal. First, illiquidity. Your money is often locked up for 3, 5, 7 years, and there's no secondary market to bail you out. With that ATM deal I told you about, when that went bad, I couldn't just sell and cut my losses like you can with stocks. I had to watch it die slowly over 12 months. Even worse, many deals have capital call provisions, meaning they can demand more money from you during the hold period if things go sideways. You're committed whether you like it or not. Second, high minimums. Many deals require $50,000 to $100,000 minimum investments. Some funds want $250,000 or more. This isn't Robinhood. You can't just start with $100 and dollar cost average your way in. This creates a concentration risk problem. If you have $500,000 to invest and the minimum is $100,000, you can only diversify across 5 deals maximum. That's not enough diversification for this level of risk. In a great portfolio, position size is foundational. Third is manager risk. Your return depends entirely on the skill and integrity of the operators, and you have zero control once you wire the money. Pick the wrong sponsor and you could lose everything. I learned this the expensive way. The sponsor controls everything. They choose the properties, manage the renovations, decide when to sell, and handle all of the financing. If they're incompetent, inexperienced, or worse, dishonest, your money is gone. And unlike public companies, there's minimal regulatory oversight. The fourth is complexity. These aren't simple investments where you can just look at a stock ticker. You need to understand the business model, the local market, dynamics, capital structure, the renovation timeline, the exit strategy, and the sponsor's track record. Most people wing it because they think, oh, real estate's simple, and then they get burned. You're essentially underwriting a business plan created by people you've never met in markets you don't know, using strategies you might not understand. Here's the big lesson. After 20 plus private equity deals, success in private equity comes from having a system, not from luck or trying to find the next hot deal. After those early mistakes, I developed what I call the Wealth Ops framework. I started treating my wealth like a business where I'm the CEO. This framework has 3 phases. Architecture, where you lay out the blueprint of your wealth management business. You define your financial vision, investment thesis, and strategic goals. The second is build. This is where you construct the essential systems and infrastructure. You'll hire your team and establish the right entity structures and implement your tech stack. Run. This is where you systematically deploy capital using specific criteria for operator selection, deal analysis, and a curated network. You track performance and optimize like a business with quarterly reviews. Here's what this framework delivered for me. Over the past 3 years, despite not having a W-2 job, my net worth has grown from $6 million to $7 million while generating $15,000 monthly in distributions. It's because I have a system for ensuring I get into the right deals and that they align with my wealth goals. Here's what most people don't realize. We're in a unique window right now. Interest rates are creating distressed opportunities in real estate and business acquisitions, but they're also making the cost of waiting extremely expensive. Every month you're sitting in cash or low yield investments. You're losing purchasing power. This could be the difference between retiring at 45 versus working until 65, between being trapped by your wealth versus being freed by it. Look, I could have stayed in that safe world of index funds and 4% withdrawal rates, but I would still be sitting in that Manhattan office, disappointing my family every Friday night, waiting until I was 65 to actually live. Private equity, when done right, has the ability to turn your Fidelity account balance into meaning monthly cash flow for your family. If you have $1 to $30 million in net worth and you're tired of being trapped by your wealth instead of freed by it, I've created a free masterclass that breaks down the exact wealth ops framework that runs my microfamily office. Go to wealthops.io, but only if you're serious about becoming the CEO of your own wealth and you're ready to stop playing the accumulation game. In the meantime, you can check out this video to get a detailed breakdown of what a microfamily office is and why it's so powerful.